Imagine walking into just a regular restaurant in your neighborhood.
Right. Something you pass by every day.
Exactly.
Yeah.
And you know for a fact, like you've seen the raw numbers, that this specific company is breaking every single sales record in its entire corporate history.
We're talking pulling in literal billions of dollars.
Billions. But uh, when you actually look around the physical dining room, something just feels a bit off.
How do you mean?
Well, there are fewer people standing in line than there were the year before. The tables are, a bit emptier. The physical space just feels noticeably quieter.
Yeah, that would feel pretty counterintuitive.
Right. And yet, if you look at their financial statements, the cash register is ringing louder than ever.
It really forces you to completely rewire how you evaluate a business. I mean, we are so culturally conditioned to look at a line stretching out the door and think, wow, now that is a thriving company.
Absolutely.
But in the modern economy, a crowded room is just no longer a prerequisite for record-breaking profits.
I'm Jack.
And I'm Misha.
Welcome to this deep dive. Today, we are opening up the hood on a massive piece of financial machinery, which is Chipotle Mexican Grill's official 2025 annual report, their Form 10K.
It's a really fascinating document to dig into.
It really is. So our mission today is to figure out exactly how this burrito giant actually works beneath the surface.
Right, getting into the nuts and bolts.
Exactly. We are going to unpack the products they sell, who their target customers actually are, and the incredibly unique and, frankly, risky way they run their business model.
Not to mention the fascinating reality of their 2025 profitability and their cash flows.
Right, because in 2025, their total revenue hit an absolute all-time high of $11.9 billion.
Which is just staggering.
Staggering. But, and this is the kicker, the actual physical foot traffic in their existing stores actually went down.
Yeah.
How does a company actively lose foot traffic but still manage to make more money? Okay, let's unpack this.
So, to understand that paradox, you really have to start with the foundation of, well, what they are actually selling.
Right, the food.
Yeah, but if you just glance at the menu board, it's famously simple, right?
Ah.
You have burritos, bowls, quesadillas, tacos, and salads.
The classics.
The classics. But from a purely operational standpoint, the physical food is almost a secondary byproduct.
Wait, really?
Yeah, because the real product they're selling to the market is a corporate philosophy they call food with integrity.
Ah, right. Which is something they hammer home constantly in the 10K.
Over and over.
It's not just some marketing slogan. It's a very rigid set of operational rules. Like, they use no artificial colors, no artificial flavors, and no artificial preservatives.
None at all.
Right. And they rely heavily on what they brand as responsibly raised meats. And that specific product promise dictates exactly who they are trying to attract as a customer.
Yeah, and when you look at the consumer data in the report, it's really a dual-pronged customer base.
Okay, break that down for us.
Sure. So the first persona is the conscious consumer. This is someone seeking high-quality, ethically sourced food that is prepared using, classic cooking techniques.
Like actual chopping and grilling in the back.
Exactly. But they want it at a relatively accessible price point compared to a traditional sit-down restaurant.
Makes sense.
But the second persona, and this is the one that is rapidly taking over their strategic focus, is the ultimate convenience seeker.
The convenience seeker.
Right. This is someone who demands that exact same high-quality meal, but they want it with absolutely zero friction.
Zero friction meaning?
Meaning they don't want to park, they don't want to stand in line, they don't even want to talk to anyone.
Yeah, that makes a lot of sense. But, it sounds like they are walking a supply chain tightrope.
How so?
Well, they want to be a fast food giant, right? But they completely refuse to use the traditional fast food playbook of frozen, heavily processed ingredients.
Oh, yeah, that is a massive point. Most fast food chains achieve scale by standardizing everything to the point of indestructibility.
Exactly. They use frozen patties and preservatives that let inventory just sit in a freezer for months.
Right. And by refusing to use that traditional playbook, this company is essentially building a glass house in a hurricane zone.
Wow. A glass house in a hurricane zone. That's a great way to put it.
Yeah, because they were incredibly vulnerable to the slightest disruption. The 10K actually dedicates a massive section to detailing that exact vulnerability.
Because they have raw ingredients everywhere.
Precisely. They handle raw chicken in the back of every single restaurant. And because they rely on fresh produce without those artificial preservatives, they are entirely exposed to supply chain shocks.
So, like, a bad storm could derail things.
A massive weather event, a drought in an agricultural region, or an animal disease outbreak like avian flu.
Right.
It doesn't just hurt their margins, it physically disrupts their ability to serve food. They can't just dip into a strategic reserve of frozen inventory.
Because there is no freezer.
Exactly. Every single day, they have to safely source, transport, and prepare fresh food across thousands of different locations.
Which naturally leads to the big question, right? If the product is this complex to source and, like, so fragile compared to traditional fast food, how do they distribute it so effectively?
It's a logistical miracle, honestly.
You'd think they would want to outsource some of that operational headache to franchisees, right?
You would think so, but they do the exact opposite.
Okay, tell me about that.
So by the end of 2025, they had a staggering 4,042 restaurants.
Over 4,000.
Over 4,000. But the defining characteristic of their business model, the thing that separates them from almost every other major player in the fast food space, is that they own and operate nearly all of them outright.
That is such a crucial distinction.
It really is.
Because if you look at a McDonald's or a Subway, they operate heavily on a franchise model.
Right. Completely different playbook.
The corporate entity essentially acts as a brand licensor and a real estate company. They collect a royalty fee from an independent operator, and that independent operator takes on the massive capital risk.
Yeah, the operator pays for the building, they hire the staff, they run the day-to-day operations.
Right. But aside from, I think it was 14 partner-operated stores over in the Middle East.
Yeah, through the El Shaya Group.
Right, through them. Aside from those 14, this company owns its entire North American footprint.
And holding that much direct ownership gives them total, absolute control over that fragile supply chain we just talked about.
Because they have to maintain the standards.
Exactly. If you are serving raw chicken and preservative-free vegetables, you simply cannot afford a rogue franchisee cutting corners on food safety.
No, that would be a disaster.
A total brand disaster. But owning the stores also means you shoulder all the capital risk. When they want to expand, they have to pay for the bricks, the mortar, the kitchen equipment, and the training themselves.
Every single dime.
Every dime.
And what they're choosing to build right now is fundamentally altering the DNA of the company.
It's a complete pivot.
It is. The 10K reveals some just mind-bending numbers about the digital revolution happening inside these stores.
The digital numbers are wild.
In 2025, digital sales made up 36.7% of all food and beverage revenue.
Almost 37%.
Think about that. More than a third of their entire multi-billion-dollar business is happening on a screen, not at a cash register.
Wow.
And furthermore, over 16% of their total revenue came exclusively from third-party delivery services.
So that's a massive volume of burritos being assembled for people who are miles away from the actual restaurant.
Literally miles away.
It completely changes the required layout of the kitchen, doesn't it?
It has to. Here's where it gets really interesting. They opened 334 brand new stores in 2025.
Okay.
Out of those new builds, an incredible 257 included a feature they call the Chipotle.
The Chipotle.
Yeah. That is roughly 80% of all new construction dedicated to this specific concept.
That's a huge bet.
A massive bet. And for you listening who might not have driven past one recently, a Chipotle is a drive-through, but it operates entirely differently than a traditional fast food window.
How so?
You cannot pull up to a speaker box and order. It is an express lane designed exclusively for picking up digital orders you've already placed on your phone.
Oh, wow. The cultural shift here is massive.
It really is.
Historically, this brand was built entirely on the stand-in-line concept. I mean, the whole theater of the experience was walking down the glass line.
Pointing at the food.
Right. Looking at the fresh ingredients, asking for a little more rice, and watching your meal be assembled right in front of you.
Yeah, the visual appeal.
Exactly. But the Chipotle actively removes the customer from the visual experience of the food. It turns the restaurant into a high-volume, faceless digital fulfillment center.
It caters 100% to that convenience seeker persona you mentioned earlier.
Exactly.
So they are pouring hundreds of millions of dollars into buying real estate, pouring concrete, and installing these high-tech drive-through lanes across the country.
Right, which takes a ton of cash.
Tons of cash.
Yeah.
Which brings us to the actual financial performance in 2025. And this is where we hit that central paradox we mentioned at the very beginning of the deep dive.
Right, the busy but empty phenomenon. Let's lay out the headline numbers. Total revenue for the year was $11.9 billion.
$11.9 billion.
Yes, which represents a 5.4% increase from 2024.
Okay, so that sounds great.
On the surface, yeah, that looks like a healthy top-line beat. But then you look at the bottom line, the actual net income they took home after all expenses.
Right.
Net income was $1.535 billion. That is almost perfectly flat compared to the $1.534 billion they made the previous year.
Wow. So revenue went up, but profit stayed completely flat.
Exactly.
It feels like a leaky bucket.
Leaky bucket.
Yeah, like if you really look at the mechanics of those numbers, it's not a healthy growth story, it's a treadmill. They're running at an absolute sprint, spending massive amounts of capital to open 334 new restaurants, pouring more water into the bucket just to keep the overall top-line revenue growing.
Right.
Because the stores that are already open, the existing water in the bucket is actually leaking out. Those stores are losing momentum.
That's a perfect analogy. You see that loss of momentum in a specific metric called comparable restaurant sales.
Right, the comp sales.
Yeah. This tracks the performance of stores that have been open for at least 13 months. It filters out the artificial boost of grand openings.
Got it.
And in 2025, comparable restaurant sales actually decreased by 1.7%.
Decreased.
Yes. And the primary driver of that decrease was foot traffic. The total number of transactions in those existing stores fell by 2.9%.
Which goes back to the empty dining room we talked about. Fewer people are walking through the doors at the restaurants they already operate.
Exactly.
But wait, if transactions drop by nearly 3%, how did they manage to keep their overall profits completely flat? They had to have pulled some major operational levers.
They absolutely did. The first and most obvious lever was menu prices.
Of course.
Yeah, they raised prices across the board by 2.1% in 2025. But here is the fascinating psychological detail hidden in the data. Even though prices went up by 2.1%, the average check size only went up by 1.2%.
Wait, how does that work?
The reason for that gap is a metric called negative check mix, which came in at negative 0.9%.
Okay, if you're hearing this and wondering how prices can go up 2%, but the average bill only goes up 1%, it means you and I are actually changing our behavior at the counter.
Yes, exactly.
The negative check mix means consumers are actively managing their own budgets in real time. We are looking at the new, higher menu prices, wincing a little bit, and deciding to offset the cost.
Right, making a trade-off.
Yeah. Maybe we skip the side of guacamole, or we ask for a free cup of water instead of buying a fountain drink, or we split a larger meal.
The consumer is absorbing the price hike by downgrading their order.
Fascinating.
So pricing was the first lever. The second lever to keep profits flat was slashing corporate overhead.
Okay.
They managed to reduce their general and administrative expenses by 6.5%.
That's significant.
It is. The filings detail that they saved millions by heavily reducing stock-based compensation and performance bonuses at the corporate level.
But overhead is just the corporate office.
Right.
What about the physical reality of actually making a burrito? I mean, you have inflation impacting every sector of the economy. How did the cost of raw materials actually impact their margins when you compare 2024 to 2025?
This is where the story gets nuanced. If you look at the raw materials, the food, the beverage, and the packaging, those costs actually improved slightly.
Improved.
Yeah. They came in at roughly 29.6% of total revenue, which is an improvement of a fraction of a percent from the previous year.
Wait. How did food costs improve as a percentage of revenue when food inflation is constantly in the headlines?
Well, they were absolutely fighting strong economic headwinds. The financial documents specifically call out a hit from the new tariffs enacted in 2025, and they faced localized inflation specifically on beef and chicken. Those are very real, factual financial realities adding to the daily cost of operations. However, because they raised the menu prices by 2.1%, they were able to entirely offset those specific hits.
Oh, I see.
Yeah, the price increase outpaced the raw inflation of the ingredients.
So they successfully passed the cost of inflation and tariffs directly to the consumer.
Exactly.
But the raw ingredients are only one part of the equation.
Right.
What about the people actually assembling the food and running the Chipotlanes?
That is where the margin improvement was completely wiped out.
Wow.
Labor costs rose to just over 25% of revenue, which is an increase from 2024.
Okay.
And that bump was driven by two factors. First, standard wage inflation, paying workers more per hour to stay competitive.
Right.
And second, the inherent inefficiency of losing foot traffic.
Right, because you still have to staff the restaurant.
Exactly. When your transactions drop by nearly 3%, but you still have to pay a full crew of employees to staff the digital make line, man the Chipotlane, and watch the front counter, your labor cost as a percentage of your revenue naturally spikes.
That makes total sense. And it wasn't just labor eating into the margins. Other operating costs climbed to almost 15% of revenue.
Yeah, they did.
And the 10K is very transparent about why. They had to dramatically increase their spending on marketing and promotions.
Advertising.
Yeah, exactly. They are essentially having to buy more advertising to try and lure back the customers they alienated when they raised prices.
Right. This raises an important question about the long-term viability of their strategy.
What do you mean?
Well, the filings openly acknowledge that consumer discretionary spending is incredibly tight right now.
Very tight.
They aren't just competing with other fast food drive-thrus anymore. They explicitly note that they are fighting for market share against grocery store meal kits.
Oh, interesting.
Yeah, and delivery aggregators that can easily steer a price-sensitive customer toward a cheaper alternative.
Right, so think about this for a second. If you take a step back and look at the whole picture, it's a massive dilemma. You are losing physical foot traffic.
Yeah.
Your response is to raise prices to cover inflation, tariffs, and rising labor costs. But every time you pull that pricing lever to protect your profit margin, aren't you risking pushing even more of your loyal customers into the arms of a cheaper competitor?
It is a delicate balancing act, and it truly tests the ultimate pricing power of that food with integrity brand.
It really does. But, despite all of that, the margin squeeze, the dropping foot traffic, the treadmill of opening new stores, the sheer scale of an $11.9 billion business still generates an absolute mountain of cash.
When you look at the cash flow statements, this company is a financial juggernaut.
The operating cash flow is staggering.
Staggering.
This is the pure cash generated by the day-to-day business of selling food before you account for investments or financing.
Right. In 2025, they generated $2.1 billion in operating cash.
Wow.
That is perfectly flat with 2024, maintaining their status as a cash printing machine. The 10K does mention that this figure was slightly impacted by the timing of tax payments related to the new One Big Beautiful Bill Act.
Right, which just affects timing.
Exactly. But fundamentally, the core engine of the business is pumping out just over $2 billion in cold, hard cash every 12 months.
Now, what do you do with $2 billion in cash?
That's a good problem to have.
It is. Well, first, you invest in the physical footprint. Their investing cash flow shows they spent roughly $666 million on capital expenditures.
Building those Chipotlanes.
Right. That is the physical reality of pouring concrete for those 334 new restaurants, building out the lanes, and remodeling older locations.
Yeah.
But interestingly, their overall investing cash use was incredibly low, only about $35 million for the year.
And the reason for that massive drop, because it was down from over $830 million the year prior, is that they aggressively pulled back on buying external investments.
In 2025, they decided to keep the vast majority of their cash internally.
Which sets the stage for the financing cash flow. And frankly, this is the most eye-opening part of the entire 10K.
It really is.
So what does this all mean? They reported cash leaving the company in financing activities to the tune of $2.5 billion.
Wow.
Why did $2.5 billion exit the building? Because they spent $2.4 billion buying back their own common stock on the open market.
To put the sheer scale of that number into context, in 2024, they spent $1 billion on stock buybacks.
Okay.
They more than doubled that expenditure in 2025.
Unbelievable.
And according to the board authorizations detailed in the report, they still have another $1.7 billion earmarked to buy even more shares in the future.
If you're listening to this and you aren't living and breathing corporate finance every day, seeing a $2.4 billion stock buyback probably triggers a very logical question.
Yes.
Well, if you have billions of dollars in surplus cash and you know your foot traffic is dropping because your customers are feeling financially squeezed.
Right. Why not use that cash to lower menu prices? Why not take a hit on margins for a year to win back market share instead of buying your own stock?
It's a fair question. From a consumer perspective, lowering prices makes total sense.
It does.
But from a corporate finance perspective, especially for a mature company that doesn't pay a regular cash dividend, share buybacks are the ultimate tool for engineering shareholder value.
Okay, unpack that a bit.
When you generate $2 billion in cash, and you've already funded your 300 new Chipotlanes, letting that surplus sit in a low-yield bank account actually hurts your financial metrics.
It's the classic pie analogy, right?
Yes, exactly.
If you go out onto the open market, buy up your own shares, and essentially destroy them, you shrink the total number of slices that exist.
Right.
The pie itself didn't get any bigger. We established earlier that their net income was completely flat for the year. But because there are fewer slices in existence, every remaining shareholder suddenly owns a slightly larger percentage of the company.
Which mathematically forces a key metric called earnings per share, or EPS, to go up.
Ah, of course.
Because they bought back so much stock, their earnings per share actually rose from $1.11 to $1.14, even without generating a single extra dollar in total profit.
That is fascinating.
It signals massive confidence to Wall Street. It's saying, we believe our own stock is the best investment available.
Right.
It's a highly efficient way to reward your investors and keep the stock price healthy during a transitional period where organic store traffic is taking a dip.
So we've unpacked a massive amount of corporate machinery today.
We really have.
Let's distill the big takeaway for you guys. This 10K paints a vivid picture of a company testing the absolute limits of corporate pricing power while navigating a massive cultural shift toward digital convenience.
Yeah, that sums it up perfectly.
You have a business facing undeniable headwinds. A nearly 3% drop in existing store foot traffic, inflation on core ingredients, and the impact of new tariffs. But they are managing to essentially bulletproof their bottom line by sprinting on the treadmill of new store construction, transforming their footprint into digital drive-through fulfillment centers, and using their massive cash reserves to execute multi-billion-dollar stock buybacks. They're figuring out how to make more money from fewer people.
But, reading through the lines of this report leaves us with a really fascinating thread to pull on for the future.
What's that?
As they continue to lean on price increases to protect their margins, the cost of a burrito is only going to climb.
Sure.
At what point does that friction-hating, convenience-seeking customer finally hit their breaking point and look elsewhere?
Right, because everyone has a limit.
Exactly. And we noticed a very quiet detail buried in the venture fund section of the 10K.
Oh, this was super interesting.
Yeah, they are actively investing capital into a company called Vebu.
Vebu. Yeah.
And Vebu is not a food supplier. They are a restaurant automation technology company.
That is incredibly telling. If human labor continues to get more expensive and the logistics of sourcing fresh, preservative-free ingredients keep squeezing the margins, you have to wonder what the final evolution of this business model looks like.
Yeah.
Will the burrito of the future even be rolled by human hands?
If the trend toward faceless digital pickup continues, the answer might be automation.
That slightly quieter dining room we pictured at the very beginning of this deep dive.
Yeah.
It might not be a symptom of a struggling restaurant at all. It might just be the quiet early stages of a highly automated digital burrito factory.
It's a wild thought.
It really is. Thanks for joining us for this deep dive. Keep looking beneath the surface of the businesses you interact with every day.